So this is our final class of the year, and it's been a long semester, but a good one, and we have just this last class to go. We've studied all the material in the book in chapters 7 through 14, with the exception of a couple of sections that we skipped in chapters 12 and 13, which are about more advanced topics in taxation that if you stay in taxation, you'll learn down the road with respect to retirement planning and benefits planning and some of the things about qualified retirement plans. So let's go ahead and let's see. We really don't have to play this, do we? So so we can turn off the overhead. If I get back into Wolfden, I'll plug it back in. But let's look at chapter 7 on investments. And in this chapter, we had 4 learning objectives. And the learning objectives that are important for the test are to understand the taxation of interest and dividend income, and also to be able to calculate a deduction for the investment interest expense. So I'd like you to take a look in your book, if you can open it up to chapter 7 and to page 7-7 on investments, and to look at the key facts with respect to interest and dividend income. So typically interest is going to be taxed at ordinary rates. Cash interest payments are taxed annually. Accrued market discount, which we didn't spend a lot of time talking about, is taxed at sale or maturity. Savings bonds are taxed at sales and maturity. We did talk about that, about the Series E and Series EE bonds and that sort of thing. And original issue discount is taxed annually. And we didn't spend a lot of time on original issue discount. That's something that you typically would cover in a more advanced course. For dividends, dividends are taxed annually, and there's a thing called qualified dividends, which are domestic companies or certain foreign companies that report to the IRS, and those qualified dividends that are paid out of their earnings and profits are taxed at preferential rates. And so that's an important thing to know from this class. It's one of the main things you'll have to remember. You know, what I tried to do is I tried to pick the things that if you went into a tax practice now at kind of an introductory level, that you'd be expected to either know or to learn quickly. And so that's that's really what we tried to focus on. So in further along in chapter 7 in learning objective 3, and I'm looking at pages 26 and 27 in the chapter. We've got this examples 7:12 and 7:13 about Courtney. Remember Courtney? We were stuck with her for several weeks. And suppose that she recognized the following income from investments. She had $1,500 of qualified dividends, $500 of taxable interest. And this question gets into how much of her investment interest is she going to be permitted to deduct. And so the rule is that you can deduct investment interest up to your amount of, you can deduct investment interest expense. So if you borrow money to make investments, you can deduct that up to the amount of your investment income, but that doesn't include dividends that are taxed at a preferential rate. So in other words, you can't get an ordinary deduction for interest but then take the income in as at a preferential rate. And so qualified dividends for most taxpayers are going to be taxed at 15%, whereas ordinary income rates, I think in the example with Courtney, is that she was paying tax in her regular rate at about 24%. And so the answer to this question is that her investment interest deduction is limited to $500. The amount of her interest is only included in the calculation of her investment income. And then there's an example down at the bottom of the page where what if she had made an investment in some undeveloped land, and she borrowed money from her credit union, and she had $2,500 of interest expense, and how much of her, she's got the same investment income, 500 from interest and 1,500 from, qualified dividends. How much is she allowed to deduct? Well, the answer is just that $500. So even though she has $2,500 of investment interest from an investment that's wholly unrelated to the investment income that she's earning, her investment interest deduction is limited to the $500 of interest income that she's received. Now, what if she cut the trees off of that raw land and she had, $4,000 or $5,000 in proceeds from the sale of the trees off of that land that she invested in? Well, in that case, then she could take the full amount of her $2,500 as investment interest expense. Okay, so that's how that works. Any questions about that? Okay, let's move on. As you've noticed, I'm not taking attendance here because I can take attendance in my head when there's only 4 people here. So, question number 3 for your final exam, we're going to move into Chapter 8. And so what I want you to know about here is the first part of Chapter 8 talks about the regular federal income tax computation. Remember that we skipped a lot of the stuff about the alternative minimum tax because I thought that was just too complicated to try to cover in the limited time that we had in this class, and we covered a lot of stuff. I mean, we really covered a lot of stuff. This book would be the same kind of book that you would see in a graduate course in individual income taxation, although you would probably spend a whole lot more time. It would probably be a 4-credit course at the graduate level. But in any event, the example 8.3, 8-3, which is begins on page 4 of Chapter 8 and continues on through page 5, is an important one to review for the final exam. And what it shows is that even with the calculation of the regular income tax rates, that qualified dividends are going to be taxed at that separate rate. So this was the example of Courtney with her $700 of dividends, qualified dividends, and then she's regularly in a 24% bracket. So remember that the tax bracket that you're in is sometimes referred to as your marginal rate. So with respect to that extra $700 of income, you have to choose whether or not to tax it at the 24% rate or to tax it at the lower rate for qualified dividends, 15%, which is also her tax rate for other preferentially taxed income such as capital gain income. So capital gain income tax rate, the marginal rate for that is typically the same rate as the marginal tax rate for qualified dividend income. That's 15% for Courtney in this example, and so the answer is $105. That's the 15% rate that we use for qualified dividends, not the 24% rate. That's her overall rate. Now, later on in Chapter 8, when we get to tax credits, so this chapter is about the individual income tax computation and tax credits. We have to learn about lots and lots and lots of tax credits. And you remember we had an example in both the quiz and the homework for Chapter 8 with respect to tax credits. And one of the most important credits that you're ever going to learn about for most taxpayers, because this includes taxpayers with income up to close to $60,000 before it phases out. So we're talking about a lot of, not just lower income, but also middle income taxpayers. And and this is the earned income credit. And you'll see an exhibit 8-11, which gives you a truncated version of the 2022 earned income credit tax table. And so your exam is open books and open notes. It's just not open neighbors. So you can certainly have your book open as you take your exam, and you can kind of follow along with the questions. But this Exhibit 8-11 is one that you should know where to find and find quickly, although you will have, whatever, 4 or 5 days to take the exam. But there's an example 8-23, and what this example asks you to do, if we remember it, is that Courtney had earned income of $180,000, and so her AGI is way too high to even qualify for the earned income credit. So after your book highlights that, then it says, well, what if Courtney didn't have $180,000? What if her only income was $30,000 in salary? And so if she had $30,000 in salary, what would her earned income credit be as somebody who has the certain filing status that she has? Remember what she was. She was head of household, and she had 2 children. And so based on head of household and 2 children, you have a certain rate that she qualifies for the earned income tax credit, but then based on her income being over a relatively low threshold, there's a phase-out percentage that you have to apply. And so if you look at the answer and the calculation at the top of 8-32 and learn that well, you'll be well served as you take your exam. Yeah?
I'm sorry, I might miss this, but so there's no time limit once you just open the exam?
Excuse me?
There's no time limit once the exam is open?
No, there's no time limit. No. It's yeah, it's open book and open notes. So if you need to go back and check your material before you submit it, if you want to, start the exam on Friday, and maybe do one time through it and then check everything on Saturday and then submit it, that's fine. So that's no problem.
When are you opening it?
I'm going to open it on the 30th. So I think is that Wednesday? Yeah, that's Wednesday. It's due Sunday.
Okay.
Due Sunday. Sunday at 11:55. So if you'd like to stay up late, just make sure that you have it in before midnight. In fact, 5 minutes before midnight. Okay, let's go on to further on in Chapter 8. There is some material about taxpayer prepayments and filing requirements. So make sure that you're familiar with how estimated tax payments are treated, how withholding is treated, and the calculations that go through with the credits and the refundable credits, non-refundable credits, and how that math works for that. Obviously, once you've determined a tentative tax, you have to apply the various credits that the taxpayer has, and certainly estimated tax payments and withholding are the most important of those. So be familiar with that. And now let's move on to Chapter 9. Chapter 9 was about business income deduction and accounting methods. And if you study tax further in your career, you'll spend a lot of time looking at business income deduction and accounting methods. And I would encourage any of you who want to study more tax to sign up for my course in business taxation, which will be in the spring. But notwithstanding that, we've got 4 learning objectives, and you should be familiar with all of those. I do want to highlight a couple of those, though. One is on identifying the common business deductions. Make sure that you know the basic standards. This is, if you studied tax further, you'd learn that this is Section 162 of the Internal Revenue Code. But in order to get a deduction for business expenses, they have to be ordinary and necessary. That's a key term. And they need to be, on the next page, page 5 of the chapter, reasonable in amount. So page 4, ordinary and necessary, page 5, reasonable amount. And then there's additional tests that you need to learn. Make sure they're not, reasonable amount means not extravagant, not unusual, not something that bears no relation to the income to be derived from the business. So those are important things to be familiar with when you take your final. Then for the rest of the chapter, there's also some material on the accounting periods that you have to choose from based on the different type of taxpayer that you are. And as an individual, you're generally going to be on the calendar year. So if you're an individual taxpayer, calendar year. If you're a business taxpayer, whether you're on the calendar year or can use a fiscal year depends on whether or not you're a flow-through type of organization. So if you're a partnership or an S corporation or an organization that's taxed as a partnership like an LLC, you're typically going to be on a calendar year, although S corporations do have, there's a lot of S corporations that were set up before they had to have calendar year conformity, and so a lot of them have very complicated calculations that you have to make to annualize and report the S corporation income in a manner that conforms to the shareholders, who are almost all individuals, calendar years. For C corporations, though, for regular business corporations, usually C corporations are the larger, more significant corporations that you'll think of, the ones that are public companies and that sort of thing. They're generally allowed to select any kind of year, as long as it's 12 months and ends with the end of the month, with the exception of businesses that choose to be on a 52-53 week year end. That's used for a lot of retail businesses that still take physical inventory after the last sale on a weekend. So that's accounting periods, and I think those are probably the two most important things that we'll find in Chapter 9. So let's go on to Chapter 10, and Chapter 10 was a lot about property acquisition and cost recovery. And again, this was material that I thought we should cover, but I thought it was pretty complicated. And so for the final exam, I really only have one question for Chapter 10. I'm going to ask you to take a look at the section on Section 197, Intangibles, that begins on page 10-31, and know that material very well. Intangibles are something I think that we should know because they include startup costs for the business. They are involved with purchases of businesses for patents and trademarks and things of that nature. And so do be familiar with that. And that's it for Chapter 10. Now for Chapter 11, Chapter 11 is probably the most important chapter for your final exam. It's the source of both of your problems, and it also has a fair number of multiple choice questions. So property dispositions, the sale of property, is something you should be very familiar with. I don't know how many pages this chapter has in full, but I would encourage you to be familiar with the entire chapter if it's 30 or 40 pages. So do review Chapter 11 very carefully and be familiar with the various examples that are contained in the chapter and the defined terms in the chapter. So beginning with the first section, know the formula for determining realized gain or loss on disposition of property, that the gain or loss realized equals the amount realized minus the adjusted basis. And know the various factors that go into what's amount realized, that you net out the commissions that you pay, and adjusted basis, that you net out the depreciation and other cost recovery reductions that you've claimed over time. And that affects your basis for sale when you sell things. So that's very important to know as well. Also, in the second section of the chapter, be familiar with the definition of Section 1231 assets, the character of the gain that you're recognizing, whether it's ordinary gain, capital gain, or this weird thing that's in that we can only define as a section of the Internal Revenue Code, which is Section 1231. And so 1231 assets are depreciable assets and land used in a trade or business, including rental property, that are held by taxpayers for more than 1 year. So if you had a question in which the property was sold exactly 1 year after it was acquired, it wouldn't be a Section 1231 asset, and it wouldn't be qualified for capital gain because for long-term capital gain, because long-term capital gains are only applied to assets that are also held for more than 1 year, 1 year and a day. Be familiar with example 11-5, which is a determination of the amount of gain or loss realized and recognized. So understand that although most, generally speaking, we have to recognize all realized income under Section 61 of the tax code, this chapter tells us about lots of exceptions to recognition. And so be familiar with all of those exceptions to recognition. Then also be familiar with depreciation recapture and how that affects the calculation of how much tax is paid at the ordinary level. And also be prepared to look at some of the other provisions that affect the rate at which gains are taxed. So those are the third and fourth sections of Chapter 11. And in particular, be familiar with Section 1239. Now, I don't know that I covered this more than just fleetingly in class when we went through the chapter, but this is a very important chapter. I think we did the one example maybe up at 11-12, but just be familiar with that example. Chapter 1239 recharacterizes gain on a sale of depreciable property between related persons as ordinary income to the seller. So it penalizes the seller by taxing all that gain as ordinary income. So you can't just, get to redepreciate assets, and then sell it to your related company, or you can't depreciate it and then sell it to your related company and redepreciate it and take the gain as capital gain. If you're going to get ordinary deductions in your related company, then you're going to have to take the gain as ordinary income. And so that's what Section 1239 does. And that's there's a little key fact blurb at the bottom of page 11-16, and then the example up at the top of 11-12. So make sure you're familiar with that. Then also in the next section, there is a discussion of just the rule under Section 1231, that there's a look-back rule, and remember that look-back rule is limited to the previous 5 years. You've got examples of that on page 11-19. There's a very complicated exhibit 11-7 on page 11-18. You don't have to learn that, but you do have to know the example of how to calculate it and how far you have to look back. And so be familiar with that. That's an example 11-13. And then you can see the way that it's reported on the various forms. Just be familiar with which forms are used to report these types of transactions. I think that was in your homework or in your quiz for the chapter. And then be very, very familiar with all the material about tax-deferred transactions, which is your 6th learning objective. As you know, I have a special history with like-kind exchanges, and so you should be prepared for some questions about like-kind exchanges in how to calculate not only the tax results for one taxpayer, but for every party in the transaction. And so there are some examples in here about people who trade assets with each other and what happens when you pay boot. What happens to your basis in the property that you acquired? Well, it goes up by the amount of boot you pay. What happens when you receive boot? Okay, well, then you recognize gain to the amount of the boot that you receive. Boot is the property that you receive other than the qualifying replacement property that's of like kind. So anything that you receive that's not like kind property is treated as boot, whether it's cash or some other type of asset. And only real property now can be exchanged for other real property. So if somebody's trading cars, a trade-in on cars, that's no longer a like-kind exchange. That's just two sales. So that's, at least for tax purposes, it's two sales. It might not be at the dealership for sales tax, but it is for income tax purposes now. Then also, be familiar with the whole issue of conversions, direct conversions and indirect conversions. Under the involuntary conversions rules, there's a blurb about that at the top of page 11-30, and then there's an example of the involuntary conversions, example 11-18. So be familiar with that. And then there's a discussion of installment, the installment method, and how that works, and how you calculate the gross profit percentage, and how you report the income from year to year. And so be familiar with that as well. Those are all important provisions in chapter 11. So that's a lot of material, but that's pretty important. Now, in chapter 12, we only looked at the first and the last learning objectives. We looked at the tax implications of compensation in the form of salary and wages, and we compared taxable and non-taxable fringe benefits and explained the tax consequences of those for the employer and the employee. So with respect to salary and wages, be familiar with how they're reported to taxpayers. That's part of your first learning objective. So the Form W-2 is how a business reports salary and wages to an employee. The Form W-4 is how an employee reports the amount of their withholding exemptions to an employer. And the Form 1099 NEC is how a business reports payments to an independent contractor. So those are all important things to know. Then later on in the chapter, when we're talking about fringe benefits, there's lots and lots of material here with respect to Julie's fringe benefits, but we moved on from Courtney to Julie. But we have a few specific examples of auto allowances and group term life insurance benefits that are limited in the maximum amount that they can be. So be sure to know those limits and how any excess over those limits is taxed. And then stuff about qualified employee discounts, and working condition fringe benefits, and lodging for the convenience of an employer. Those are all important topics too, although perhaps maybe less important, but they're important to know as well. In chapter 13, we only looked at retirement savings and deferred compensation with respect to the basic employee plans, but do know what the types of employer-provided qualified plans are. Those are defined benefit or defined contribution plans, and then we looked a little bit at vesting schedules for the plans, and also for the basic type of plans, but we didn't look much further than that in chapter 13. So let's go on to chapter 14, which was our last chapter, and I think we've got probably some questions about each of the learning objectives with respect to the tax consequences of home ownership. So in chapter 14, we had to determine whether a home is considered to be a principal residence, a residence that's not principal, or a non-taxable residence. We started with the definition of what's a dwelling unit. So if you have somebody who's living in a storage facility, that probably is not going to qualify as a dwelling unit. I don't know why the individual would own a storage facility, but in any event, that's probably not a good example. Remember that there are definitions for when you have a residence or a non-residence, the 14-day and the 10% of the number of rental days tests. And you can see at the bottom of page 14-3 the tax provisions by the type of property, and you can see which provisions deal with which types of property. So just be familiar with that. Make sure that you're talking about the correct type of property when you're answering the question. And then moving into the exclusion of gain or sale of a principal residence. I should be asking you all this, but I won't, since this is the review session. But there are a couple of tests to qualify for exclusion of gain on the sale of your personal residence. You must have owned the home. There's an ownership test. The ownership test is 2 years out of the 5 years prior to sale. And you must have used the home as your principal residence for at least 2 of those 5 years. And if you're married and filing jointly, both spouses have to meet the use test, although only one spouse has to meet the ownership test. So that's important for the exclusion of gain on the sale of principal residence. And that is a very, very important provision. And I can't tell you how many times I've had clients in practice where they've sold their principal residence. At the closing, they've gotten a 1099. They forget to report it on their tax returns. And what the IRS does is they don't give them the exclusion on the principal residence. There is a reporting form that you have to file to get that exclusion. And the IRS is taxing those people as ordinary income, not long-term capital gains, on 100% of what they get for their home. So you've got somebody who maybe makes $50,000 or $60,000 a year, and they sell a $100,000 house, and here the IRS is sending them a bill, for probably 25 or 30%, $25,000 or $30,000 on that $100,000 sale. And if they don't know all the things that we learned this semester about how to deal with the IRS, and how to appeal it, and how to go to the tax court and things like that, they're going to end up getting a bill, for $25,000 or $30,000 that's going to turn into a federal tax lien that's going to attach to their new house. And there's going to be no way of getting it resolved without having to go through a whole rigmarole with the Taxpayer Assistance Service and basically begging to get the tax treatment that they were entitled to in the first place, and maybe having their credit ruined for a while in the meantime. And so that's something that's very important. So the next section, the third section, is about the home mortgage interest deduction. That's the limitation on acquisition indebtedness that used to be $1 million, but now after 2017 is only $750,000. So look at the exhibit on that, or not the exhibit, but the example on that. Example 14-6 does a really good job going through that rule and explaining how it works and what happens if your indebtedness is more than $750,000, and the way that you have to prorate the interest deduction. So you only get to take the deduction based on the $750,000 part. You don't lose the deduction completely, but you have to prorate it, so you only count $750,000 of the mortgage and the interest that applies to that pro rata. Real property taxes are the next learning objective. Just understand that the overall tax limitation for itemized deductions is now limited to $10,000 per taxpayer per year. And that includes not just real estate taxes, it also includes state income tax, would also include other types of state, municipal, local taxes that are actually taxes. Make sure that they're really taxes, not that there's something that wouldn't qualify as a tax back in Chapter 1. Okay, so tolls don't qualify as taxes. they're for crossing the bridge or using the superhighway. But be familiar with how property taxes work, and go back and review tax benefit rule. Go back and review, what happens if you get a refund of taxes that you didn't get a tax benefit from. And the way that you count it is that, if you've got the taxes that you're trying to figure out if you got a benefit from when you get a refund, is you go back and you look at how much of your total taxes were disallowed because you were limited to $10,000, or how much of your total taxes were disallowed because your itemized deductions weren't substantially more than what you would have gotten anyhow as a standard deduction. So those are both examples of the tax benefit rule that can come into play when you're looking at refunds of taxes that you get the next year. So be familiar with that. Anybody have any questions about that, what I'm talking about? I think I might be losing you. I don't know if I'm going too fast or too slow. Well, anyhow, there are some rules about rental use of your home. I see that we have Mr. Williams with us, and we've got I'm sorry, I'm saying the wrong name. We have our classmate who lives in Augusta, and that may turn out to be important on your final exam. Remember what they call the master's rule, which is discussed at the top of page 14-17. And so that's what we have for that. And then, let's see, is that the last? I had one more question here. Well, it may be a surprise question. So maybe I'm going to run out of Post-it notes when I was doing this. But in any event, anybody have any questions about anything? I am recording this. Yes, so that'll be posted in Wolf Den in just a few minutes. So I think we're done for the semester. I have enjoyed it. You all did good work. You should be very proud of the work that you did on the tax court brief, and also the forms. If you haven't submitted the tax forms for tonight's assignment, please do it by the deadline. I think it's tonight at 11:55. Yeah.
Are you grading that on accuracy?
Yes. Yes, I am.
It's really hard.
Was it really hard?
Yeah, it's really hard.
Okay. Well, I won't grade it really hard. I'll grade it sort of medium hard then.
Okay, but you can turn in all like 8 forms through Wolfden?
Yeah. Oh yeah. Yeah. You can upload them all. If you're doing them on a fill-in site like at the IRS or something, you may have to convert them to a PDF first.
Okay.
I mean, you might have to print as PDF or something and then submit them. I'm not sure if the items that you load into the form transfer when you try to copy the page. Mm-hmm. I've had experiences where you just get another blank form. So just make sure that you can save a copy of what you've worked on and then upload that.